Hello friends, welcome back to the channel. If you're someone who loves trading or wants to dive deep into the world of Forex scalping, then you're absolutely in the right place. In today's video, we're exploring one of the most practical and no-nonsense books in the trading world. Forex Price Action Scalping by Bob Volman. Bob isn't just any trader. He's a full-time scalper who spent years in front of the screen, perfecting the craft of short-term trading. His book is like a personal mentor, guiding you through every setup, every entry, and every tiny detail that matters when trading fast-moving markets. But before we begin, don't forget to like this video, share it with your trader friends, and subscribe to the channel so you never miss out on more powerful strategies. Let's get started and discover what it really takes to succeed as a price action scalper in the Forex market. Chapter 1: Trading Currencies. When it comes to scalping, the currency market offers something truly unique: the perfect blend of volatility and liquidity. In this opening chapter, Bob Volman walks us through why the Forex market stands out from other trading instruments. Unlike stocks or commodities, currencies are traded around the clock. This 24-hour window ensures that traders have continuous access to price movements, which is critical for the kind of short-term opportunities scalpers thrive on. Volman explains that scalping needs a certain type of environment: tight spreads, low transaction costs, and lots of price action. And the Forex market delivers exactly that. With major currency pairs like EUR-USD or GPUSD, spreads are often as low as a single tick. That matters because scalping relies on capturing tiny price changes, so even a small edge in spread can make a difference over hundreds of trades. He also emphasizes the massive daily trading volume in currencies. Trillions of dollars change hands every day. This means price movements are smoother and more responsive to technical patterns, rather than being jerked around by a few big players. For a scalper, this translates to more reliable setups and fewer unexpected spikes. But Volman makes one thing clear: the tools you use and the way you read the market matter just as much as the instrument itself. Currencies may be ideal for scalping, but without precision, discipline, and consistency, the market will still chew you up. He sets the tone for the rest of the book by reminding readers that this is not a get-rich-quick guide. It's about building a professional-level skill. Bob Volman invites us into the world of high-speed trading, where structure, volatility, and rhythm create a scalper's playground. But he also warns, this game is only winnable with a sharp mindset and a mechanical, emotion-free approach. That's the foundation on which the rest of the book will build. Bob Volman introduces what he believes is the scalper's most powerful tool: the 70-tick chart. While most traders rely on time-based charts like 1-minute or 5-minute intervals, Volman makes a strong case for switching to tick-based charts, especially when scalping the Forex market. So what exactly is a tick chart? Unlike time charts that print a candle after a fixed period, a tick chart forms a new candle after a specific number of transactions. In Volman's approach, every 70 trades result in one new bar on the chart. Why 70 ticks? Through years of live trading, he found that this number creates the perfect balance. Not too noisy, not too slow. It captures the real rhythm of market activity. Volman explains that in scalping, time is often a distraction. Markets don't move at a steady pace. Sometimes they're rapid, sometimes they pause. A time chart can show a candle even when nothing has happened. But a tick chart adapts to the market's pace: more candles during active periods, thus fewer during slow ones, offering clarity that time-based charts simply can't provide. He also discusses how price patterns on tick charts are often cleaner and more consistent. Since each candle is formed after a specific number of transactions, the chart gives a more direct reflection of market participation. That's critical when you're trading at lightning speed and need to make decisions based on real intent, not random fluctuations. Another key point Volman makes is that tick charts help sharpen a trader's visual memory. Over time, scalpers begin to recognize patterns, price behavior, and breakout structures almost intuitively. And because tick charts are so visually distinct, they train the eye faster and more effectively than traditional charts. But Volman doesn't just recommend tick charts for aesthetic reasons. He insists they offer a genuine edge in execution. With better pattern clarity and fewer distractions, a trader becomes more precise, responsive, and confident. Chapter 3: Scalping as a Business. In this chapter, Bob Volman strips away all the romanticism around trading and delivers a grounded, no-nonsense truth. Scalping is not a hobby, it's a business. And just like any serious business, it demands structure, discipline, and a well-thought-out process. Volman starts by challenging the popular belief that scalping is high-adrenaline gambling. He makes it clear, if you treat trading like a casino, the market will treat you like a gambler. And gamblers, in the long run, always lose. Instead, he asks traders to wear the hat of a professional, just like a pilot or a surgeon. Preparation and routine matter just as much as skill. He explains that being a scalper means showing up every day with a plan, following a method, and executing trades with emotional detachment. This isn't about chasing thrill or revenge, trading after a loss. It's about building a repeatable process that produces consistent results over hundreds of trades. Volman insists that success doesn't come from having one big win. It comes from having hundreds of disciplined, boring, mechanical trades. Time management is another key aspect. Volman advises traders to carve out dedicated hours for trading, a defined session where your focus is sharp and uninterrupted. Scalping isn't something you do casually between errands or while watching Netflix. It's intense, and it demands your full attention. Capital preservation is also central to Volman's philosophy. Scalping with proper risk management is not about how much you can make. It's about how long you can stay in the game. He encourages small position sizes in the beginning, tight stop losses, and an always cautious mindset. Think longevity over quick wins. One of the most powerful parts of this chapter is Volman's emphasis on emotional self-control. Traders must resist the temptation to bend the rules or act impulsively. That's why he recommends developing a structured workflow, checklists, routines, journals, so that decision-making becomes mechanical, not emotional. Chapter 4: Target, Stop, and Orders. Bob Volman gets into the nuts and bolts of scalping, and nothing is more critical than how you define your targets, stops, and order execution. It's here that the line between professional and amateur scalpers becomes crystal clear. Volman begins with the most fundamental point. Every trade must have a predefined stop loss and profit target. No guessing, no adjusting mid-trade based on hope or fear. The goal is to build a system where trades are taken based on setups, not emotions. He outlines his standard structure, aiming for a fixed 10-tick target with a tight stop of 5 to 7 ticks. This setup offers a clean 2-to-1 reward-to-risk ratio, which is critical in scalping, where trade frequency is high and each tick matters. But Volman doesn't stop at numbers. He explains why these numbers work. A 10-tick target is realistic on the 70-tick chart. It aligns with typical short bursts in price action without becoming too greedy. On the other hand, a tight 5 to 7-tick stop keeps losses small and manageable. This tight containment is essential because in scalping, even a short losing streak can wipe out hours of effort if not managed precisely. Then comes the discussion about order types. Volman is a firm believer in limit orders over market orders. Market orders may feel faster, but they expose traders to slippage, especially dangerous in the fast-moving world of scalping. A properly placed limit order, on the other hand, gives you control over your entry price and helps you stay disciplined. You're not reacting to the market, you're waiting for the market to come to you. Another core lesson here is consistency. Volman emphasizes that traders should resist the urge to tweak targets and stops based on gut feelings. The more consistent your structure, the easier it becomes to evaluate your performance and refine your edge. Over time, this consistency builds confidence, and confidence leads to clarity in execution. Chapter 5: The Probability Principle. Bob Volman introduces one of the most critical ideas in all of professional trading, the probability principle. It's here that he shifts the mindset of the reader from trying to predict the market to trading based on statistical edge. Volman starts by reminding us that scalping is not about being right on every trade. In fact, you won't be, not even close. But that's okay, because trading isn't about perfection. It's about probabilities. He explains that successful scalpers don't seek certainty. They look for setups with a measurable edge, where the odds tilt slightly in their favor. Think of it like this. If you can find a setup that gives you a 55% chance of hitting your 10-tick target while only risking 5 to 7 ticks, and you execute that setup the same way every time, over a large number of trades, you will come out ahead. Not because you're a genius, but because you're working with math, structure, and repeatability. Volman is very clear about one thing. Emotion has no place in execution. Traders often sabotage themselves by interfering in trades mid-flight, closing early, widening stops, second-guessing entries. This kind of behavior destroys the edge. The market is random in the short term, but if you have a setup that plays out statistically over time, you must trust it, trade it, and repeat it without trying to outsmart it on every trade. Another essential point he makes is about sample size. You can't evaluate your trading strategy based on 10 or 20 trades. You need hundreds to get a real sense of its effectiveness. Volman compares it to flipping a slightly loaded coin. If heads wins 55% of the time, you might see a short streak of tails, but flip it 100 times, and the edge becomes clear. By embracing the probability principle, you stop trading for excitement, and you start trading like a statistical operator. Someone who isn't emotionally attached to individual outcomes, but is deeply committed to long-term consistency. So the takeaway from this chapter is simple but powerful. You don't need to predict, you need to align yourself with probability. And once you do that, scalping becomes less stressful, more systematic, and far more sustainable. Chapter 6, the setups. Bob Volman opens this chapter by getting to the heart of what every scalper must master. Price action setups. These are not just patterns, but well-defined entry points rooted in structure, momentum, and visual confirmation. He makes one thing very clear. You can't just guess your way into a trade. Scalping requires precision, and that precision comes only from truly understanding how price behaves in the moment. Volman introduces a series of core setups, each designed for a very specific condition in the market. But before diving into those setups in detail, which he does in the next chapters, he lays down the foundation. Structure is everything. You need to read the chart like a story. Where did price come from? Where is it hesitating? And what clues is it giving about the next move? He emphasizes the importance of momentum. It's the engine behind every good scalp. If you're entering a trade and momentum isn't there to carry it forward, even the best setup will fall flat. He also stresses visual clarity. These setups should be easy to spot, no guesswork, no forcing trades. On a 70-tick chart, a valid setup should almost jump out at you if you're focused. A key message in this chapter is about screen time. Volman doesn't sugarcoat it. To recognize these setups consistently, you need hours and hours of watching live markets. There's no shortcut here. These patterns come alive only when you've trained your eyes and mind to read subtle shifts in price behavior. And once you do, the market starts to speak a language you can understand. He warns against the danger of overtrading or taking almost setups. Those are the trades that eat away at profits. The goal is not to trade more, it's to trade better. Even one high-quality setup a day can be enough if executed with discipline and consistency. Chapter 7, Double Doji Break. In this chapter, Volman dives into one of the more distinctive price action setups for scalping, the double doji break. If you're new to candlestick patterns, a doji represents indecision in the market, a candle where the open and close prices are virtually the same, signaling a tug of war between buyers and sellers. Volman explains that when you see two doji candles back to back, it highlights a moment of tension, hesitation, and uncertainty. The market is basically pausing, balancing on a knife's edge. This buildup of indecision sets the stage for a powerful move once the market finally breaks free. The key here is recognition and timing. Volman stresses that the double doji pattern is a signpost, not a trade signal in itself. You don't enter the trade during the dojis. Instead, you watch carefully for the price to break out sharply above or below this indecision zone. That breakout is the moment to act. The breakout following a double doji often leads to strong momentum, making it a favorite among scalpers for quick moves. But Volman cautions traders to confirm the breakout's strength with volume and tick chart structure before jumping in. Not every breakout after a double doji leads to a solid move. False breakouts can and do happen. He also highlights that this setup works well in both reversal and continuation contexts. Sometimes, the double doji signals the market is ready to reverse after a trend, and other times it's just catching its breath before continuing in the same direction. What makes the double doji break setup powerful for scalpers is its clarity and simplicity. On the 70-tick chart, it's easy to spot and gives a clear entry trigger, which fits perfectly with Volman's philosophy of keeping things visual and mechanical. Volman encourages traders to patiently watch for these setups, to trust the pattern, and to execute quickly once the breakout is confirmed. Like all scalping techniques, it demands discipline and the ability to act decisively. Chapter 8, First Break. Bob Volman explains the first break setup, one of the fundamental moves in scalping price action. The first break happens when price escapes from a tight congestion zone or a narrow range for the first time, signaling a potential strong directional move ahead. Volman stresses that the power of the first break lies in its timing and confirmation. The market often spends time building pressure inside a small, contained range. Traders and institutions hesitate, waiting for a catalyst to push price out. When that breakout finally occurs, it's usually accompanied by a surge in volume and clear momentum, offering a great opportunity for scalpers. The 70-tick chart provides the perfect lens for spotting this setup because it visually filters out noise, letting you see the congestion clearly and watch the moment price decisively breaks out. Volman explains that the key is to enter early, but not too early, right as the breakout confirms, so you ride the move without getting caught in false starts. Volman also highlights the importance of watching the volume during the breakout. Volume confirms strength. Higher volume means more participants pushing in the breakout direction, which increases the chances the move will continue. Low volume breakouts, on the other hand, tend to fail or reverse quickly. Another important point is managing risk. The tight range before the breakout sets natural places for your stop loss, just inside or slightly beyond the congestion zone. This keeps your risk controlled while allowing room for normal price fluctuations. Volman reminds traders to watch for false breakouts, which are common in Forex. A false breakout looks like a strong move, but quickly reverses back into the range. To avoid getting trapped, he suggests waiting for price to close beyond the range on the tick chart before taking a position. Building on the first break, Bob Volman introduces the second break setup, a slightly more conservative yet highly reliable trade entry. After the initial breakout from a congestion zone, the price often hesitates or pulls back, creating a second breakout opportunity that confirms the strength of the emerging trend. Volman explains that the second break is essentially a confirmation move. The first breakout signals a possible directional shift, but it can sometimes be a false start. The second break, occurring after a brief pause or retracement, provides clearer evidence that momentum is real and the trend is likely to continue. This setup appeals to scalpers who prefer to avoid the riskier early entries and instead wait for more confirmation. Volman points out that while the potential reward might be smaller than the first break, the success rate often improves with the second break because it filters out many false breakouts. On the 70-tick chart, the second break usually follows a small pullback inside or near the former congestion area. Price action here is critical. Traders watch for rejection of lower or higher prices and signs that buyers or sellers are regaining control. Volume analysis also plays a role, as an increase in volume during the second breakout signals real buying or selling pressure. Volman stresses the importance of precise stop placement in this setup. Because the second break follows a pullback, stops can be set tighter, just beyond the pullback's extreme. This helps control risk while capitalizing on a more confirmed move. Patience is key. Traders must resist the temptation to jump in too early during the pullback or hesitate too long after the second breakout. Volman emphasizes practice and screen time to develop the skill to time these entries perfectly. Chapter 10, Block Break. In Chapter 10, Bob Volman introduces the block break setup, a key strategy based on breaking out of clearly defined price congestion blocks. These blocks are visually distinct areas on the chart where price has been moving sideways or consolidating tightly. Volman explains that a block represents a zone of balance between buyers and sellers, a pause in the market's flow where forces are evenly matched. The moment price breaks out of this block, it signals that one side has gained the upper hand, setting the stage for a potential strong move. What makes the block break setup especially valuable for scalpers is its clarity and structure. Because the block is easy to identify on the 70-tick chart, it gives traders a clean reference point for entries, stops, and targets. The breakout is not random. It's based on a logical shift in supply and demand dynamics. Volman emphasizes watching how price interacts with the block's boundaries. The breakout must be decisive, meaning price moves beyond the block's edge with convincing momentum and volume. Hesitation or weak breakouts often lead to false signals, so confirmation is key. Risk management is straightforward here. The block itself defines natural stop-loss levels just beyond the breakout boundary. This helps contain risk while giving price enough room to breathe. Volman highlights that the balance between risk and reward is often very favorable in this setup. Importantly, the block break can be applied in multiple timeframes, but Volman prefers the 70-tick chart for scalping because it filters out noise and sharpens entry signals. He also notes that these setups work well in trending markets, but warns traders to be cautious during choppy or sideways conditions. Finally, Volman reminds scalpers that patience and discipline are crucial. Waiting for a clean breakout without forcing trades inside the block will lead to better results over time. Bob Volman explains the range break setup, a classic and widely used scalping technique that focuses on price breaking out from clearly defined horizontal ranges. These ranges are periods where price moves sideways between well-established support and resistance levels. Volman highlights that recognizing these ranges accurately is essential. The range boundaries act like invisible walls where buyers and sellers meet in balance. When price finally breaks through one of these walls, it signals a shift in market control and the start of a new directional move. Using the 70-tick chart, scalpers can easily identify these ranges with precision. Volman points out that tick charts filter out time-based noise, making the boundaries of the range sharper and easier to trade. This clarity helps traders avoid false signals that often plague traditional time charts. Volman advises waiting for a clear breakout candle beyond the range boundary before entering a trade. The breakout should be backed by strong volume and momentum to increase the chances of a sustained move. If the breakout is weak or volume is low, it's safer to hold back and wait. Managing risk is straightforward with the range break setup. Stops can be placed just inside the range, slightly beyond the breakout level, to protect against sudden reversals. The range itself defines logical target levels for scalpers to aim for quick profits. However, Volman warns traders to be cautious during choppy or flat market conditions. Breakouts during such times often fail or lead to whipsaws. Patience and discipline are key. Waiting for clean, strong breakouts rather than forcing trades inside the range will improve success. The range break setup provides scalpers with a clear and structured method to capture moves that begin when price escapes horizontal consolidation. With proper timing, volume confirmation, and risk control, it's a powerful tool to catch swift and profitable trades. In Chapter 12, Bob Volman explores a more subtle and advanced setup called the inside range break. This technique builds upon the traditional range break but focuses on price action occurring within a larger, clearly defined range. Volman explains that within a broad price range, smaller internal ranges often form. These are tighter areas where price consolidates briefly before the next move. The inside range break setup looks to capture breakouts from these internal consolidations rather than waiting for a break of the entire outer range. This setup requires sharp observation and quick decision-making because the price shifts involved are smaller and can be less obvious. On the 70-tick chart, these internal ranges become clearer, allowing scalpers to spot potential breakout points sooner. The key idea Volman stresses is that pressure builds within these inner ranges. Traders and institutions test the boundaries repeatedly, creating tension that ultimately breaks with momentum. A breakout inside the larger range can signal an early start to the next directional move or a short-term momentum burst. Volman warns that the inside range break demands a good feel for market context and price structure. False breakouts are common, so confirmation through volume and price action is critical before entering trades. Traders must remain disciplined, only taking entries when the breakout candle convincingly closes beyond the internal range. Risk management is equally important. Stops should be placed just inside the internal range boundary, which naturally limits risk while giving room for normal price fluctuations. This setup appeals to scalpers looking for multiple, quick opportunities within the same overall market environment. It requires patience and practice to master, but it adds a valuable edge by allowing traders to act earlier than waiting for larger moves. In this chapter, Bob Volman takes the range break setup to the next level with the advanced range break, a more nuanced approach that sharpens a scalper's ability to read pressure buildup, fakeouts, and breakout quality within ranges. Volman explains that not all breakouts are created equal. Some come with strong momentum and volume, signaling genuine market commitment, while others are false breakouts designed to trap traders and reverse quickly. The advanced range break teaches how to differentiate between these. Central to this setup is the observation of price action patterns and subtle signals, indicating whether pressure is mounting to break out or if sellers or buyers are trying to deceive the market. Volman highlights how watching the sequence of candles, their wicks, and volume clues can reveal the true strength behind a breakout attempt. The advanced range break often involves multiple attempts to break the range boundaries. Volman advises patience and reading the market context carefully, looking for signs like a series of higher lows before a breakout or exhaustion candles near the boundary. Using the 70-tick chart, traders can see these details clearly, allowing for quicker decisions. Volman stresses the importance of waiting for confirmation, such as a strong close beyond the range or an increase in volume, to avoid falling prey to fakeouts. Risk management remains a cornerstone. Volman suggests tight stops just inside the range, but also flexibility to adjust based on breakout strength. Sometimes, waiting for a pullback after a breakout can offer a safer entry with better risk-reward. This chapter refines scalpers' intuition, combining technical precision with experience to recognize quality breakout setups. The advanced range break is ideal for traders wanting to elevate their scalping game by avoiding traps and maximizing high-probability moves. Chapter 14, Tipping Point Technique. In this chapter, Bob Volman introduces the tipping point technique, a powerful tool for managing trades by reading momentum shifts at critical price levels. This technique helps scalpers identify the exact moment when market sentiment changes, allowing for confident entries and timely exits. Volman explains that momentum is the heart of scalping success. Price moves in waves of buying and selling pressure, but these forces don't last forever. The tipping point is where the current momentum starts to weaken and a reversal or pause is imminent. Spotting this moment can make the difference between a winning trade and a costly loss. Using the 70-tick chart, Volman teaches traders to watch price action closely around key support and resistance zones, or after breakouts from setups like range breaks or block breaks. When price reaches these critical areas, the intensity of buying or selling often reaches a peak. This is the tipping point. Volman emphasizes the importance of watching candle formations, volume changes, and the speed of price moves. Signs such as slowing momentum, smaller candles, or wicks showing rejection signal that the tipping point is near. This lets scalpers either lock in profits or avoid entering trades that have lost steam. The tipping point technique encourages patience and sharp focus. Instead of chasing trades impulsively, scalpers learn to wait for clear evidence of momentum shifts, helping them avoid emotional decisions and unnecessary risks. By mastering this approach, scalpers can improve trade management dramatically, entering with conviction when momentum builds and exiting gracefully before it fades. This technique ultimately helps maintain a consistent edge and protects capital over the long term. Volman highlights the crucial skill of knowing when not to trade. He stresses that avoiding trades in unfavorable conditions is just as important as executing good setups. Scalping demands clear, reliable price action, and certain market environments make this difficult or even dangerous. Volman explains that low volatility periods are one of the biggest challenges. When the market moves sluggishly, price tends to get stuck in narrow ranges, producing false breakouts and choppy action. Scalpers trying to force trades during these times often face losses because momentum is weak and unpredictable. Another major risk comes from erratic price behavior, sudden, unpredictable swings caused by external events or thin market liquidity. These can create sharp spikes or reversals that catch traders off guard. Volman warns that scalpers should recognize when price is messy and avoid jumping into uncertain moves. High-impact news events add another layer of risk. Volman advises staying out or greatly reducing trade size during announcements like economic data releases or central bank statements. The market often reacts violently and erratically during these times, making scalping highly risky. Volman encourages traders to develop the discipline to sit out rather than trade just to be active. He points out that protecting your capital and confidence is more valuable than chasing setups in poor conditions. Overtrading in bad markets leads to frustration, stress, and losses. In Chapter 16, Bob Volman tackles the vital topic of trade volume, how much you should trade, and why position sizing is crucial for successful scalping. Volman explains that even the best setups and strategies can fail if trade volume is not managed properly. Scalping involves many quick trades with tight stops, so the risk on each trade must align with your overall account size and risk tolerance. He emphasizes the dangers of overtrading, taking too many trades or risking too large a percentage of your capital on each. This often leads to emotional strain, poor decision-making, and ultimately, losses. Keeping position sizes reasonable helps maintain a calm, focused mindset, which is key for consistent profits. Volman advises traders to calculate their maximum risk per trade based on a fixed percentage of their account, usually between 1% to 2%. This ensures that even a series of losing trades won't severely damage the account, allowing the trader to stay in the game longer and learn from experience. He also discusses the importance of adjusting trade volume based on market conditions. In more volatile periods, smaller sizes may be prudent to reduce risk, while steadier markets might allow slightly larger positions. Volman encourages using a systematic approach to volume management, just like with entries and exits. Treat position sizing as a critical part of your trading plan to protect capital and emotional well-being. In this closing chapter, Bob Volman offers honest and practical words of caution for anyone considering scalping as a trading style. He reminds us that scalping is mentally and emotionally demanding, requiring more than just a good strategy. It demands discipline, resilience, and self-awareness. Volman emphasizes that scalping is not for everyone. The rapid pace, constant decision-making, and high frequency of trades can be overwhelming, especially for those prone to stress or emotional reactions. He encourages traders to honestly assess their personality, temperament, and mental stamina before committing. He also warns against the common pitfall of overconfidence. Even skilled scalpers face losses and setbacks, and staying humble is key to long-term success. Volman stresses the importance of continuous learning, self-reflection, and accepting that mistakes are part of the journey. Another caution is about the illusion of easy money. Scalping looks attractive because of its quick trades and small profits, but Volman reminds us that consistent profitability comes only through hard work, preparation, and emotional control, not luck or shortcuts. He advises traders to manage expectations and be patient. Scalping success builds slowly and requires sticking to rules, managing risk, and not chasing every market move. Finally, Volman encourages maintaining a balance between trading and life outside the markets. Avoid burnout by taking breaks, managing stress, and not letting trading consume your identity. Thanks for watching, everyone. If you found this video helpful, don't forget to like, share, and subscribe to the channel for more in-depth trading strategies and book summaries. Hit the bell icon so you never miss an update. And if you have any questions or want me to cover more topics, drop a comment below. I love hearing from you. Until next time, happy trading and stay disciplined.